Today I want to talk about DCF, or Discounted Cash Flow Analysis. Many finance courses start with DCF. They start with net present value analysis. The fundamental principle in finance is that a business proposal will raise firm value only if the present value of expected future cash flows exceed the initial cash outlay. In a perfect market, competitive buyers for business proposals will bid away all positive expected net present value. And this is perhaps the reason why Thomas Carlyle, a great thinker of the 19th century, dubbed economics the dismal science. So in a perfectly competitive market, positive NPV projects do not exist. So if you're an analyst and you see a positive NPV project, you've got to stop and ask yourself, what part of perfectly competitive economics is missing here that enable this project to be positive NPV? The positive NPV is evidence of an economic rent. The rent shows that the return to the productive resource in producing the good or service is greater than the cost of the production. Managers who maximize shareholders' value are driven to be rent seekers, and analysts who look at projects should identify where the monopoly rents arise from. Managers seek value propositions. They look for products and services that create value for end users. The good or service that's created should be a must-buy, so that the user is willing to pay a premium over the cost of production. Good NPV projects are large, high-growth, high-margin, and more importantly, with significant barriers to entry, and they fit the resources of the company. Analysts quantify value in expected cash flows and discount those to present value. So here's the fundamental principle of finance. The net present value of a project is simply equal to a series of cash flows. The cash flows start at time zero and recede into the far future, here represented by the infinity sign. Each cash flow is discounted at a cost of capital. I've identified the K here as the weighted average cost of capital, which we'll come to in a later lecture. The return to that capital, each year's cash flow, is discounted back to present value by an appropriate discount factor, and the question is the total sum greater than zero? Note that only cash matters. We bring it to present value, so we're bringing it back to time zero, and these are expectations. Within the numerator, this is the expectation at time zero of a future cash flow, so these are projections. Once again, if NPV is less than zero, value is destroyed. If NPV is greater than zero, value is created. If we're dealing with a company whose shares are publicly traded and the information becomes public on a given day, then the increase in the capitalization of the shares will equal the net present value of the project. I'm going to now talk a little bit about discounting. Discounting is simply the division by a discount factor, and it converts future expected cash flows into their equivalent value today. We'll cover the estimation of the discount rate in the cost of capital discussion. We will cover the identifying of cash flows in the capital budgeting discussion. Here we'll just look at the mechanics of discounting. The mechanics of discounting are the same as the mechanics of interest. Let's say the year one rate is 1%. That means we'd be indifferent between having $101 in 1 year and $100 today. So the future value is simply the present value times 1 plus the interest rate. Here the interest rate is 1% or 0.01. The future value is 100 times 1.01. The present value is simply the future value discounted at 1 plus the rate of return for that appropriate horizon. If we're expecting $101 in 1 year's time and the interest rate is 1%, then we discount it at 1.01 to get a present value of 100. If you're promised $200 in 1 year for the price of $195 paid today, the present value of the outflow is $195. The present value of the inflow is simply 200 divided by 1.01, which is $198.02. The net present value is $198.02 minus $195, what you have to pay out today, $3.02. The future value of the outflow is $195 times 1.01, or $196, so the net future value is $200 minus $196.95, or $3.05. You'd accept the deal. Note that we could calculate net future values, or we could calculate net present values, but we tend to calculate net present values in finance because there is only 1 times 0 today, and yet there's an infinite number of future times, so it's better to bring things to present value rather than leave things in a future value. But the principle of equating cash flows to a single point in time is the same. The calculations that I've just given are only for a 1-year horizon. Interest is typically quoted as a rate per annum. If the rate is constant at the 1-year rate for n years, we can calculate future value or present value with respect to an n-year horizon. And we simply can bring the present value times 1 plus r to the n to get the future value, the nth year future value. To take the nth year future value to a present value, we would take the future value and discount that by 1 plus r to the n. If we had to calculate the rate of interest given a future value and a present value, we just take the price relative of the future value divided by the present value, raise it to the power 1 over n, and subtract 1. So if the 5-year annual rate was 1% per annum, the 5-year return would be the 1-year return raised to the power 5, or 1.01 to the power 5, which is 1.05101. Let's say we had a promise payment in 5 years of $200. If the cost this year is $190, then the net present value would be 190.29 minus 190, which is equal to 0.29, and one would accept. You'll note that the difference between compounding 1% per year for 5 years to get 5.101% is not much different from simply adding 1% across 5 years to get 5%. The reason why is that compounding for low interest rates does not make much difference. But compounding's effect dramatically increases with the interest rate and with the years of investment. Here on the x-axis we show years of investment, and here on the y-axis we show the value of $1 compounded out the years of investment on the x-axis at different rates of interest. So at 0%, $1 compounded for 10 years is simply $1. And yet at 20%, $1 compounded for 10 years is well over $6. Most cash flows in net present value analysis are multi-period cash flows, not just a single cash flow occurring at the nth year. So here it's very useful to use spreadsheets. Let's say the discount rate is 10% and our cash flows are $100, $200, $300, $400, and $500 at the ends of years 1, 2, 3, 4, and 5. The discount factor is simply 1 divided by 1 plus r here, 1 divided by 1 plus 1, 0 to the power t. So those translate into discount factors of 0.91 for year 1, 0.83 for year 2, 0.75 for year 3, 0.68 for year 4, and 0.62 for year 5. Multiplying the discount factor of 1 divided by 1 plus r to the power t times the cash flow gives you the present value for each year's cash flow. And then adding across all years, we get the present value at year 0. Here I was using an Excel spreadsheet to do the calculations. I'm simply multiplying across from the cash flow through the discount factor. I've calculated my discount factors as indicated, and I calculate my present value simply by adding across. But I could use Excel's own formulas. Here is the NPV formula, which is embedded in Excel. NPV open brackets, my discount rate is B1, and I identify the cash flows as years 1 to years 5 in B4 to F4. So I get exactly the same result whether I explicitly calculate or I use Excel's formula. And if I were offered this cash flow for $1,000 today and the risk-adjusted opportunity cost of capital were the discount rate that I used of 10%, the net present value would be $1,065.26 minus $1,000 or $65.26, and one would take it. Annuities are cash flows that pay the same amount every year for some period of time. Perpetuities are annuities that last forever. Here's the formula for the present value of a perpetuity. Here's the formula for the present value of an annuity. Let's look at a perpetuity paying $1 per year. That perpetuity would have $1 discounted for the first year at 1 plus R, plus $1 discounted for the second year at 1 plus R squared, $1 discounted for the third year at 1 plus R cubed, and so on ad infinitum. Now if we take the left-hand side of this formula and multiply it by 1 divided by 1 plus R, multiplying it by the discount factor for the first year, and we take the right-hand side of the formula and multiply it by 1 over 1 plus R, the discount factor for the first year, then we find the left-hand side of the formula is 1 over 1 plus R times the present value, and the right-hand side of the formula is 1 over 1 plus R times 1 over 1 plus R, which is 1 over 1 plus R squared, plus the second term 1 over 1 plus R squared times 1 over 1 plus R, which is equal to 1 over 1 plus R cubed, and so on for all of the terms ad infinitum. Then we have a series that can be subtracted. So PV 1 plus R minus 1 over 1 plus R is equal to 1 over 1 plus R. Subtract here, present value is simply equal to bringing that 1 over R. So the present value of a perpetuity of $1 a year is simply equal to 1 divided by the discount rate. From the formula for a perpetuity, one can derive the formula for an annuity. Think about a perpetuity that starts in year 1. We'll call it P1, the present value. Let's say it pays $1 a year. And another perpetuity that starts in year T. We'll call that P2. So the present value of P1 is simply 1 over R. Present value of the perpetuity that starts in year T, since it's also a $1 per year perpetuity, is 1 divided by R. However, it starts in year T, so we have to bring it back to year 0 present value by dividing by 1 plus R to the T. So the present value of the perpetuity at year 0 starting in year T is 1 over R divided by 1 plus R to the T. Now the present value of the annuity starting in year 1 and going to year T is simply this term minus this term. So it is simply 1 over R minus 1 over R divided by 1 plus R to the T. The present value of an annuity starting in year 1 and ending in year T is simply 1 minus 1 plus R to the power T, all divided by R. I'd like to wrap up by making a distinction between two somewhat confusingly similar terms. One is effective annual rate, and the second is annual percentage rate. Rates are often quoted in annual percentage rates, and yet these lead to different effective annual rates depending on the frequency of payment. So let's say we have two securities. One is 10% paid semi-annually, and the other is 10% paid quarterly. These 10% paid semi-annually and quarterly are annual percentage rates, and to convert them into effective annual rates, we have to make this adjustment. Looking first at the annual percentage rate of 10% payable semi-annually, that's equal to 5% actually paid every 6 months. The effective annual rate is 1 plus 10% divided by 2 to the power 2 minus 1, which is equal to 10.25%. The effective annual rate is 25 basis points higher than the annual percentage rate. Let's look at the second example. If the annual percentage rate is equal to 10% quarterly, then the effective annual rate is equal to 1 plus 0.10 divided by 4, all to the power 4, minus 1, which is equal to 10.38%. So that here you can see that payments on a quarterly basis yields 38 basis points above the rate if this was an annual percentage rate of 10% paid annually. So once again, we can see the advantage of earlier payment. That brings to a close the introduction to discounted cash flow. Discounted cash flow brings cash flows that occur at different times to a common basis, either to future or present value, by applying the time value of money. Typically, we bring them to present value. When you're doing so, you must be careful about the timing of cash flows and about the discount rate you use, and of course about the definition of that discount rate.